Now let's look at evaluating investment decisions as the second session in this module. In the financial plan section of developing a business plan, we considered looking at the analysis of ensuring that the business plan that you have written, the financial plan, actually makes sense given all the parameters that we looked at in developing that plan. Right now, we want to consider what critical things we need to look at when we're faced with one or more investment options. As an objective, this would help us to define what an investment project is, explain the impact of investment decisions. We'll be able to describe information needed to analyze an investment decision, and also be able to apply techniques in project analysis. And finally, we should be able to identify sources of capital for an investment project. In terms of content, we will look at investment projects and the impact on business. We'll also look at required information for the financial analysis of an investment project. We'll look at techniques applied in financial analysis, and then we'll look at sources of capital for an investment project. Part 1. Investment projects and the impact of investment decisions. What is an investment project? Simply put, an investment project refers to a long-term plan to outlay various resources for income or profit in the future. The process of project implementation must impact corporate financial growth for more than 1 year. And it's only this that shows that you are, as far as business is concerned, that you're involved in an investment project. The next natural question to ask is, so what qualifies as an investment project? Normally, investment projects are related to the following decisions. 1, reduction in costs, that is machinery and equipment procurement, can be done in order to lessen repair and maintenance costs. Extension of business activities, that is expanding factories to increase productivity and extending into new distribution channels aimed at increasing the market share of selecting among alternative options, buying or leasing machinery, replacing equipment now versus doing that the following year. Managers of SMEs often think that investment projects are issues that only big companies need to be concerned about. However, investment projects are routinely occurring activities in the management of any business. Things like building a new office or renting one, whether it's an office or a factory, buying a new photocopy machine to reduce maintenance costs, purchasing or leasing a shuttle bus that serves the company's employees, and so on. These are things that qualify as investment decisions. Let's now look at the impact of investment decisions. Firstly, investment decisions impact 3 main areas of the business. Because of the orientation of this program, we will concentrate on 2 main subjects, which are the impact of investment decisions on financial positions and the financial results of business during and after the implementation of a project. The impact on financial positions relate to the financial flexibility which may be reduced because of a conversion of short-term assets, that is capital, into tangible assets, that is investment project, and then a long-term period of capital recovery. The impact on financial results could also depend on the future investment decisions that can result in opportunities that generate profits or risks of not profiting from an investment project. The third aspect is corporate taxation, but we will not discuss that in this module. When we make investment decisions, there are so many information that is required for us to be able to make the right analysis and be sure that we're taking the right decision as far as investment decisions are concerned. So let's look at the required information. In order for us to get the right information, we consider two broad types of data to get the right information for investment decisions. These are non-financial data and financial data. It's usually erroneous to think that to take a proper investment decision, you look at only the financial data, because there are so many other things that might affect the profitability of a company, which might not necessarily be financial. In terms of non-financial data, things like market demand, technology, feasibility, regularity of events within the environment that the company operates are some of the things that are considered to get the right data out for information to be used for investment decisions. For financial data, we look at investment capital, cash inflow, cash outflow, the duration of the project, and if purchasing an asset, does that asset have a residual value? And then what's the profitability of the whole investment? Financial data is usually collected after non-financial data or information has been determined. Non-financial data is not covered as such in this program. However, they should be accurately collected and assessed to ensure a meaningful quantitative analysis. The collection of financial data should be closely linked to the method of investment analysis the company already has in place. Techniques related to investment project evaluation will be duly addressed in a little while. Of all the financial data requirements that were discussed earlier, two main ones form the central theme when discussing investment projects. These are investment capital and profit. Investment capital is the total asset value to be outlaid when making an investment decision, while profit is the increase in cash flow generated from the investment that has been made. A critical point of discussion when considering the outcome of an investment project is the concept of the net cash flow. By implication, net cash flow indicates that there was cash flow coming in, and there's a cash flow that comes out as a result of whatever the investment project has been utilized to do. The concept of profit and cost, that is expenses, is often expressed in financial statements, but this is not used when we consider investment decisions. This is because cash is considered as king as far as business transactions are concerned. So we'll prefer to use the word cash flow, as cash inflow and cash outflow, and not profit in our discourse of investment decisions. Having laid the background on investment decisions and the general concepts of the information required for investment decisions, now let's look at the techniques that are applied as far as financial analysis is concerned for investment decisions. When analyzing a project and with the view of selecting the optimal project, it's important for managers to take on an active role in making these decisions. Analyzing alternatives refers to the measurement of alternatives and deciding whether they meet the targeted requirement. This presupposes that the managers have an expectation of the requirements of their investment projects, and then they will need to take a decision if the project or the alternative active projects meet any or all of the measurements that they have set. Selecting an alternative addresses the consideration of those alternatives that have already met the targeted requirements and deciding upon the optimal decision. So what are the techniques that we use? When making an investment decision, investors want to be able to know the forecasts, the results in a wide range of aspects. The three factors presented here are some of the more popular ones and correspond to three frequently used analyses and technique. These are payback period, net present value, and internal rate of return. So let's look at the three one after the other. Payback. Payback period identifies the period of time required to recover the invested capital for the project. This has nothing to do with the time that it takes you to pay back a loan, but rather the time it takes the project to generate sufficient cash flow to cover the amount that was invested in the first instance. How do we use this? Every project has an expected lifespan that it needs to cover up the amount that was invested in it based on the level of patronage, the number of units sold, and so on. So, when the period that it takes a project to generate sufficient cash flow to cover its invested sum, when that period is less than or equal to the expected period, then we say that the investment is good and should be accepted. However, the time that it takes the investment to generate sufficient cash flow to cover it, to recover the amount that was invested, is greater than the expected period, then that project is said to be unacceptable. Please note that this is based on the net cash flow from that investment project. We explained net cash flow earlier as the cash that is used for investment as against cash that is gotten from the results of the investment. Net present value. Net present value looks at the total value generated from a project. Again, when we talk of total value generated here, we're saying the net cash flow. Built into the calculation of the net present value is the concept of time value of money, which means that it looks at the future cash flow of the investment project. The net present value is based on the amount of cash inflow that is generated from the project and not based on the accounting profit. This measure considers changes in monetary value over time. To calculate net present value, you calculate the present value of the cash inflow, calculate the present value of the cash outflow, and then you net them off. So you remove the present value of the cash inflow from the present value of the cash outflow. That's how you get your net present value. So how do we use it? Whenever NPV, that's the net present value, is greater than 0, then we say it's acceptable. That is the difference between cash inflow and cash outflow. Put simply, when cash inflow is greater than cash outflow, then we say the investment project is acceptable. On the other hand, when cash inflow is less than cash outflow, which makes the NPV lower than 0, then we say it's unacceptable. It could so happen that cash inflow and cash outflow balance themselves out. So which means the NPV is 0 at this point also, that project is acceptable. The third technique is the internal rate of return, IRR. IRR refers to returns generated from each naira of capital invested. This can also be said to be the return rate when net present value is equal to 0. Mind you, this also takes into account the time value of money. So it looks at how much the naira invested would be worth X number of years down the line. The question to ask is, does every invested naira produce returns as expected? We're not going to bother you with the calculation of the internal rate of return. Just remember the IRR is the estimated rate of profit during the project's implementation. So how do we use it? When we have our expected rate of return, if the calculated IRR is greater than the expected rate, then the investment is acceptable. Also, if the calculated IRR is equal to the expected rate, the investment could also be said to be acceptable. However, when the IRR is lower than the expected rate, then you should consider rejecting the project. Would I use only one technique to make a decision? The truth is, depending on the kind of investment that you are evaluating, one technique might be a bit more appropriate than the other. Remember, payback shows the shortest time period. NPV shows the net cash flow, while IRR looks at the rate of return per naira of investment. So when considering an alternative, you should look for one with the shortest payback period, one with the highest NPV alternative, and or one with the highest IRR alternative. In terms of comparison, all of these have their suggested usage, and we need to understand each of these so as to be able to apply the appropriate technique for the appropriate investment. To overcome the weak points of the payback period technique, analysts usually also consider the interest rates based on the return of cash inflow to calculate the timing of capital recovery. NPV and IRR are only two different points of view. NPV presents an absolute value, while IRR shows a relative value. When you're analyzing projects which investment capitals are not the same, please don't use the NPV. My question now would be, in making investment decisions or evaluating them, should I only consider financial analysis? The answer is no. Aside from an analysis of financial costs, other non-financial costs and benefits pertaining to the project should also be considered. The purpose of a non-financial cost-benefit analysis is to evaluate the social impact of a project. To analyze an investment project, managers should assess the non-financial costs and benefits in combination with each other. In reality, many projects are evaluated bringing in very high non-financial benefits. For example, an increase in employees' satisfaction, working conditions, and so on. The investors still decide to invest even when their financial benefits are slightly low. or lower than expected. To close up this part of the discussion, it's important to note that analyzing investment options strictly on financial benefits might not give the required basis for making an investment decision. However, we should evaluate both the financial and non-financial data in order for us to be able to take a balanced decision as far as investment decisions are concerned. The next part of our discussion would be sources of capital for an investment project. The sources of investment capital has concerns in two major ways. One is, where are we getting the capital from? That's the source of the capital for project implementation. And two, what's the strength and weak point for all sources of capital? There are two main sources of capital. These are long-term capital, which could include owner's equity, long-term loans, investors' equity, and so on. Short-term capital will include several things like short-term loans, suppliers' credits, and things like that. Usually, in investment projects, especially for long-term investment projects and long-term assets acquisition, people tend to use more long-term capital, and while people use short-term capital more for working capital, to fulfill working capital requirements. The principle of capital allocation, therefore, is that you should be cautious about using short-term capital to finance the long run. One important principle to consider is that short-term capital should be used for things that can quickly generate returns and can be returned quickly, than using short-term capital to finance long-term projects like a long-term asset acquisition. When deciding on capital to be acquired, a major consideration is interest rates. Interest rates can be in the form of interest charged on loans from a bank or other financial institution. It could also come in the form of dividends on owner's equity or shareholders' equity. Please note that no capital comes free and clear. A cost is attached to it. And in deciding on which capital source to use, you weigh the cost vis-a-vis whether you should go for loan or you should go for equity.